right, guys, welcome to another session on strategic financial management. So our objective for today would be twofold. The first would be to complete our question 1, May 2025 question on the merger, with key focus on business valuation, because the principle is the same, whether you're doing the merger, you're doing acquisition, principle is always the same. We're trying to determine what is the company worth, so that if we are merging, we'll determine what's the right value, what's the right price for that transaction. And if you are demerging, we'll determine what is the right price of value to sell that part of our business that we're demerging to sell. And for the party that is buying as well, they would also have an idea of what the right value is to buy that entity. And that's something that is important that we know. So in our previous class, we looked at May 2025 and we solved a part of the question, which was the part A. So let's get right to where we stopped last week. So I want to believe that if you missed the class, you've had a chance to catch up on the part A of that of this question. So just to give us a quick recap of the question, we'll just quickly reread the question, and then we'll go right back to where we stopped in our solution and continue from where we stopped. So let's begin by quickly rereading the question so we can remind ourselves of what the question we're currently on right now. Okay, so this is May 2025, question 1, and then we'll go there. It's Kola PLC. So let's go ahead with quickly rereading the question. So it says, just to remind ourselves really, it says Kola PLC is a large listed company involved in 2 business sectors. Its main business is in the production of food and drink for supermarkets and other large traders. It also owns a chain of restaurants nationwide. Kola's board of directors think that the company is undervalued and is of the opinion that it should focus on the rapid innovation taking place in the food and drink production sector. So that's Kola, 2 business line, food and production and restaurant. And they're saying, guys, can we focus on food and production and let restaurant be on its own or something? And that's the crux of the question. So what has Kola decided to do? The second paragraph. Therefore, Kola board of directors has decided to unbundle the restaurant business into a company called ZK. And Kola PLC can either spin off or sell ZK after the merger, so that Kola can focus. Sorry, let me a few guys. Okay, so that Kola can focus on its remaining business of food and drink production. Initially, Kola shareholders will own ZK on the basis of owning 1 ZK share for every Kola PLC share owned by them. So that was the initial decision. Let's take out the restaurants, and our existing shareholders would own it initially. But then things begin to change. MK Ltd is a large unlisted company controlled by 20 shareholders who all have significant stake in the business. MK Ltd owns a number of hotels around the country and is looking to diversify into the restaurant business. MK Ltd has approached Kola PLC about the possibility of purchasing ZK Ltd. MK Ltd will finance the purchase either through a cash-only offer or a share-for-share offer. So that's another company. MK is looking at Kola and is like, I think we can buy or we can acquire Kola. And they're saying, okay, if we're going to acquire Kola, how do we pay for it? And they're considering 2 things. One is we pay cash. The second is we give the shareholders, or we issue to the shareholders our share. So those are the things they're considering. If ZK is demerged, it will be listed on the stock exchange as an independent company. Kola PLC is unsure. They don't know whether to sell ZK Ltd to MK Ltd or demerge it into an independent company. So we have Kola PLC statement of financial position currently given to us right here. The question moves on. Kola PLC shares are trading at 2.45 each and have an equity beta of 1.3. The part of the business which will become ZK Ltd accounts for 24.5% of Kola PLC's total equity value. Kola PLC's loan notes A currently have a total market value of 2.1 million, 2100 million. Loan notes B currently have a total market value of 400 million. The pre-tax cost of debt has been determined at 4.3% for loan notes A and 4.1% for loan notes B. After the unbundling, loan notes B will be serviced by ZK Ltd and loan notes A will remain with Kola PLC. But the pre-tax cost of debt for both will increase by 0.3. It is expected that ZK Ltd will maintain its capital structure after the unbundling. MK Ltd's debt to equity ratio is estimated to be 40 to 60 in equivalent market value terms, and it has 1,200 million shares in issue. The restaurant industry is dominated by Yani PLC, a large listed company which owns many restaurants around the country. The average equity beta for the restaurant industry is estimated at 1.38. The average debt equity ratio in the restaurant business is 20/80. All companies pay corporate tax at a rate of 20% per year, and tax is payable in the same year as the profit it is based on. The risk-free rate of return is estimated at 3%, and the market risk premium at 7.2%. The following estimated information is applicable to ZK. So they give us all of the information in this paragraph. So we can say one time. The following estimated information, this part, it applies to the acquisition of ZK by MK Ltd if ZK Ltd is acquired. So they give us the information on the price earning ratio and all of that information there. They give us the statement of the current statement of profit or loss as it is currently. After the acquisition, it is expected that the PE ratio of the combined company will be midpoint between the two individual companies' PE ratio. The annual after-tax profits will increase by 62 million due to combination of the two companies. MK Ltd has proposed to pay for acquiring ZK Ltd either through a cash offer, we've mentioned before that they're looking at cash offer or issue of shares of 0.66 for a ZK Ltd share, or 1 MK Ltd share for every 3 ZK Ltd shares. MK Ltd will borrow the money needed to pay for the acquisition. Required, estimate the value of each ZK Ltd share if it is demerged and listed as an independent company. Note, calculate to the nearest million except per share data that should be done to 2 decimal places. B, estimate 1, the additional equity value created when combining MK Ltd and ZK Ltd. 2, the percentage gain to each under each payment method. So what is the percentage gain to MK under cash? What is the percentage gain to ZK under cash and then under share? So under each method. 3, the impact of MK Ltd capital structure under each payment method. And then C, evaluate the financial and other factors that both MK Ltd and ZK Ltd shareholders will consider prior to agreeing to the acquisition and the impact of MK Ltd capital structure under each method. So that's the question we're considering. So what's the gist of the question quickly as a recap? You have Kola Limited that has a business that is into food and food production, and they also have a restaurant business. And they've told themselves, let us take out or unbundle the restaurant business so that we can focus on our food and production business. So the decision now is, what do we do with the restaurant business? So when they unbundle the restaurant business, they call it ZK Ltd. And they are thinking of the fact that, do we keep this restaurant business or do we sell it? And then there is a company called MK Ltd that is into restaurant, hotels, really, but not into restaurant. And they're thinking of buying ZK Ltd. And so they're trying to say, okay, we're going to buy it either by paying cash or by issuing shares. So the first part of our question is, what is the value of ZK if it is demerged? And that's because you need to know what the value of the restaurant is, so that if you decide to sell, you don't sell it below what you think you're worth. And if MK decides to buy, they don't pay above what the company is actually worth. So that's where we are. And in our first class, our first session last week, we did a computation of the value of ZK Ltd. But the question is value of each share. So we're going to calculate the value per share. But in our previous class, we determined the value of ZK Ltd using the free cash flow method. Now, I also mentioned something last week, which is a very good exam tip. Questions like this are going to be very large. So you're going to have a lot of pages, a lot of content. So you're not all over the place, so you don't mix up things. So what you basically would do is, for every question, you look at the section of the question that has information on that, except for maybe other areas where you have general information that applies to everything. For example, tax would apply to everything. But in terms of specific requirement, you look for the part of the question that has information that is related to that. So let's go back to our question and see what that question is again, the A part. It says, estimate the value of each of ZK Ltd share if it is demerged. So what we will just do is to go to our question and look for the part that talks about the value of ZK if it is demerged. And that's what we did last week. So all we did is to go down, go to our question and say, okay, what part is talking about if it is demerged? And we identify this part. The following estimated information will be applicable to ZK if it is demerged. So we know that the information we need to value that part of the question is around the paragraph that talks about what happens if it is demerged. We then have to determine what valuation method do we use. We identified in our first class, if you missed that, just watch the videos on the top devaluation method. We discussed the various devaluation methods. So we need to determine at that point what devaluation method do we use. And because we have cash flow, sales revenue, profit margin, we know that is cash. So we know that we needed to use the free cash flow method. And that was how we use the free cash, and that was why we use the free cash flow method to determine what the value is if it is demerged. And we arrived at the total value of 1509. Now that is the total value of the company if it is demerged. But the question is actually asks us to determine the value per share. That's what the question asks us to do, to determine the value per share. So what is it worth by shareholder? So that's what the question asks us to do, to determine the value of each ZK Ltd share. So to determine that is pretty straightforward. All we need to do is to divide the total value by the number of shares. That's all we need to do. So let's determine the value of each of those units then. So value per share, each share if demerged. Okay, quick question. Hope you guys can see my screen and what I'm writing right now. I'm actually writing right now.
Yes.
All right. Okay. So value of each shares if demerged. So that would basically be your total value divided by number of shares. So we know our total value up as 1509. Let's determine what the number of shares are. That gives us the value per share. So can we go? Let's quickly go back to our question. Determine for ZK Limited, how many shares are we looking at? So let's go right back to our question and quickly look at where it talks about the shares. So that would be a general information. So when we read the question, we mentioned somewhere here, right here. Okay, so right here, that initially, Kola PLC shareholders will own ZK on the basis of owning one ZK Limited share for every Kola PLC share owned by them. So 1:1. So if Kola PLC shares is 1,000, ZK will be 1,000 because when they set it up, they were looking at 1:1. If Kola is 2,000, ZK is 2,000. If Kola is 3,000, ZK is 3,000 because that was the plan when they first set it up. So we need to establish how many shares do we have for Kola. So let's go right down to Kola's account, which is the statement of financial position. Right here. So it mentions that Kola has in monetary value 1,000 shares, and each of these shares is 0.5 per share. So how many shares multiplied by 0.5 would have given us 1,000? It is basically 1,000 divided by 0.5. So the number of shares would be 1,000 divided by 0.5. So that is 1,509 divided by 2,000. So if it is demerged, guys, what is the value per share of each of ZK? Just a moment. Let me catch my calculator quickly. It's my calculator. Just a moment. Okay, yeah, I think I'm there now. So that's let me write that to 9 a little bit more legible. It's looking more like 1. So 1,509 divided by 1,000. Just a minute. I'm trying to fetch my calculator quickly. Okay, so that's 1.509. So we can just put that to two decimal places, which gives us 1.59.
Divided by 2,000, not 1,000.
Oh, divided by 2,000. Oh, sorry, divided by 1,000 rather. Sorry,
0.75.
Okay, 0.75. Thank you. So let me redivide that. I guess I pressed the wrong value. Okay, yeah, 0.75. So that gives us 0.75 if demerged. Okay, that's per share. Now, one thing I always tell students to do, which is very important because it guides your decision making, is even though the question is asking for the value if demerged, as in that is if Kola PLC decides to take out the ZK, it is always very important to also calculate the value if it is not demerged. So that gives you a range to work with. So you know what the current value is without the demerger. You know what the current value is after the demerger. So it gives you, because normally when you go into a business transaction to either buy or sell something, you want to have a range of what is of acceptable value. You want to know the low end and you want to know the high end. So it's always important to also determine what is the value if it is not demerged. So that really helps with decision making. So even though it is not required and that a part of the question, we need to quickly determine the value if not demerged. It's going to be, we already know what that is. It's going to be pretty straightforward. So value if not demerged. Value of ZK without demerger. That is the current value. That was the current value. So we calculated the value when we did our cost of equity, we calculated the value per share of ZK Limited, the current value per share. So okay, I think we have that in our working. Is it up or down? Okay, we have it in our working. So we computed the value per share of ZK, the total value of equity for ZK, current value of equity when we're doing our cost of capital. So we just get that and divide it by the number of shares. Yeah, so this is it. We calculated the value of equity last week of ZK Limited, the current value of equity of ZK Limited. We calculated it as 1201. The 1509 is the value if it is demerged. So if it is not demerged, the current market value for ZK Limited shares is 1201. That is the current value. So what would that translate to per share? That would be 1201 divided by the number of shares, which is 2000. So what do we have for that?
Exactly.
1201 divided by 2000 gives us
0.60.
So this is our current value. This is our current value. So that is our current value. So as an investor, what does it tell us? Currently, if we don't take any action, the way ZK Limited is, we are worth 0.60. But if we demerge it, we are worth 0.675. So that gives an idea of what happens if someone approaches you to make an offer for ZK Limited. If someone approaches it and say we want to pay 0.50 per share for ZK Limited, as the owner of ZK Limited, Kola, would you accept it? Somebody says I want to pay 0.50 for ZK Limited. Would you accept it? What do you think?
Yes.
Yeah, you said?
Yes.
Somebody said you are currently what?
No,
you are currently what? You are currently worth 0.60. And if you demerge, your value will increase to 0.75. And somebody says I want to pay 0.50 for you. Would you accept it?
No.
No, you would not, because that is below even your current value. Even before you demerge, or even taking action to demerge, restructure, and everything, what they are offering is below your current value. Is that okay? Is that okay?
Yes, sir.
All right. And if MK Limited were to come to ZK Limited and ZK Limited says we want to sell Kola for 0.90, would you pay for that as MK Limited? Will you pay that? If you're MK Limited and you approach Kola and Kola says I want to sell Kola for 0.75 as MK Limited, sorry, 0.90 as MK Limited, would you buy it? No.
No.
No, because after it is demerged, this is the value. So what are we saying in summary? What we're saying in summary is you can't buy it because after it is demerged, it is worth 0.75. So are you buying something that is worth 0.75 at 0.90? So what we're saying in summary is that for the seller, the current value is the minimum price he can accept. So the seller cannot accept or should not accept, let me say cannot, because anything can happen in this world. The seller should not accept less than its current value, because that is what it is worth before doing anything. So a seller will not accept more than that. After it is demerged, this is the value. So a buyer, even if you want to buy it, this is the maximum you can buy. buyer should not buy more than that, because it doesn't make any sense. If something is worth, after the merger, is worth 0.75, why am I paying 0.90? Okay, hope those points are clear. Very important that you know that. And that's why it's important to know what the values are. Even when you calculate, question says what is the value after, it's important to know what the value is currently before the demerger, so that you know the range of values that are applicable. So that whenever the seller, the seller is making the proposal, you determine is it worth it. And whenever a buyer is evaluating, so the seller is trying to, a buyer is trying to make a proposal, you determine is it worth it. And if whatever is a seller too is trying to evaluate whatever the buyer is proposing, you're trying to determine, can we take it or not? Okay, so that point is clear. All right. So let's go right back to the B part of our questions. Now that we established what the values are, so we'll now begin to look at, okay, what is MK saying? If at any point you have a question, guys, please feel free to make use of, don't interrupt me, but feel free to make use of the hand raise feature, and then I will call you so the class is organized. Okay, so let's look at the other part of the question quickly. It says, estimate 1, the additional equity value created when combining MK Ltd and ZK Ltd. So 2 things. We are going to look at, our question is so wide, so we're not going to be looking for everywhere. We're going to look at details for where you have information around when you combine MK Ltd and ZK Ltd, what happens. So we're going to look at what part of our question has that information. And as we do, we are focused on computing just one thing, the additional equity value. So what that basically means is we're looking for the additional. So how do you know what is additional? Pretty simple. We need to know what the value is after. We compare it with the value before, and that tells us what the addition, or the new or the additional is. So that is our B1. Additional equity value if combined. So we're going to look for information on the part that talks about what happens if combined. So that to get the information. But what we're interested in is the additional equity value. So we're trying to determine, okay, what is the value after minus the value what? The value what? Before. So that gives us what? Any additional. That gives us any additional that is added to it. So let's go right back to our question. And we're looking at the value, meaning that it's evaluation. So what the evaluation method we would use will depend on what we are given around if combined. So if we are given information on the assets, we would use the asset-based valuation. If we're given information on cash flow, we would use the cash flow-based valuation. If we're given information on price earning ratio, we would use the price earning ratio. If we're given information on dividend, we would use all of the methods we discussed. We need to know all of them, but what you use depends on what you're given. So let's go right back to our question, guys, to determine what is the value and which part of the question deals with the value if combined. So that's the best, allows an important tip never to miss. So that way you're not all over the question. So let's look at that. We've read it before, so I don't want to read through it again. So if you look through or you scan through the question, we're looking for the part that talks about if combined. So we're looking for the part that talks about if combined, if combined, if combined. All right. Yeah, right here. Can you guys see it? Right, very well, right here mentions it. Can you see it? Right here. The following estimated information applies to the acquisition of ZK by MK Ltd if acquired or if combined. So this part of the question is where we are going to, sorry, please. Is where we're going to set our tent, because that is the part of the question that speaks to what happens if combined. So the next thing will now be, what valuation method is the question talking about? It says the average price earning ratio for the hotel industry is 15.61. However, MK Limited P ratio is estimated to be 10% lower than this. It's still telling us the average earnings now. It doesn't really give us the gist of if combined yet. It moves on to tell us that extract from the current as it is now. It's telling us as it is now, these are the profit and loss account. It now says after the acquisition. So when combined or if combined. So when or if combined. So after the acquisition, it is expected that the PE ratio of the combined company will be what? Midpoint between the two individual companies' PE ratio. So it is expected. So that is what is expected to happen if combined. So from that part of the question that talks about the value if combined, what valuation method is clearly stated there that we can use? What method from all the methods we talked about? What method? What method is there? Who will help me out? It is what? The what? The PE ratio.
PE ratio.
The PE ratio. So we're going to shift our attention from free cash flow to PE ratio for the value if combined. So let's do that. So it is said if combined, the PE ratio of the new company will be midpoint between the two individual companies' PE ratio. In other words, it will be half or 50% or average of the two. That's what it basically means, of the two. And then the annual after-tax profit will increase by 62 million due to combination of the two companies. So currently it is 171, 117. It will increase by 62 million after the combination. So let's do our PE ratio quickly. All we're interested in is the value after and the value before. And then we subtract it and know what the addition or the increase is. So that is what we're interested in. So let's do a quick recap on the P ratio approach quickly. I know we've done it before, but just take 3 minutes to do it on the P ratio approach. So, two things you need to know on P ratio. One is the calculation of P ratio. And two is valuation using P ratio. The reason is because if you're given the P ratio, you would use it as it is. But sometimes you're not given the P ratio, you need to compute it yourself before determining what the value of the company is using the P ratio. Okay, so how do we calculate P ratio? It is our total earnings which would also be referred to as profit after tax, divided by the number of shares. Divided by the number of shares. And then once you determine that, we can then determine what do you call it? The valuation using the P ratio approach. So once we determine what the P ratio is, we can then determine what the value is. And what is the value? It is the P ratio itself multiplied by the total earnings. Or profit after tax. So when I said P part in bracket, I'm talking about or is also referred to as profit after tax. Okay. So that is what you need to know on P ratio. So let's go right into our question. First thing first, let's determine the values of the company before and the values of the company after. We can then compare the two. So let's begin. We can begin with either one. Maybe we can begin with before. It's always, sometimes before is always easier because that one you can get it straight off. So we can determine the value before. Value before. So let's begin with MK. What is the value of MK before? And then we calculate what the value of ZK before is. So first thing first, we need to determine what is the P ratio. If we are given the P ratio in the question, we don't need to calculate it. But if we're not given the P ratio in the question, we need to calculate it. And then after we calculate it, we then determine the value used by multiplying the P ratio by the total earnings. So let's go to the part on MK Limited and determine what is the value, the P ratio of MK Limited if we're given. Yeah, so the part on MK Limited, I think it's all about here. Okay, so it says right here, the average price earning ratio for the hotel industry is 15.61. However, MK Limited P ratio is estimated to be 10% lower than this. So MK Limited P ratio, current P ratio is 10% lower than what it is for the hotel industry of 15.61. So how much would that be? So 10% lower would be 90% of that value. So what would be the P ratio for Kola? 10% lower. So 100 minus 10% lower takes us to just 90% of the value. So that would be 90% of 15.61. So what is the P ratio of MK? Zero point
14.05
multiplied by 15.61, so 14.05. 05. Now we have determined what the P ratio is. So can we determine what the value is? What is the formula for our value? It is the P ratio we just calculated of 14.05 multiplied by the total earnings of MK Limited. And if we don't have all the profit after tax. So what that means is that we need to go, sorry, I need to accept someone. So what that means is that we need to go to where you have a profit statement and determine or find the profit after tax or the total earnings and multiply by the P ratio to give us the value. So let's do that quickly. Okay, so right here, extract of the current statement of profit or loss given to us here. So what is the total earnings of profit after tax for MK? So the total earnings of profit after tax for MK is what? 171.0. So let's multiply that by 171.0. Multiplied by 171.0 million. Okay, so what is the value of MK before the demerger? 1405, so 14.05 multiplied by 171. So that gives us 2402. 2.55 or 0.6, whatever you decide to write, 0.55, 0.6, or 2403 if you decide to round up from the very beginning. Okay, so that's the value of MK. Please feel free to make use of the hand raise feature if for any reason you want to ask me a question. Okay, so let's determine now the value of ZK before. So the same thing, P ratio, value of ZK before. So I'm gonna do that being value of ZK before. Okay. So, two steps. We need to determine what the P ratio is. If we are given the P ratio of ZK in the question, we're going to use it. If we're not given the value of ZK in the question, then we would have to compute that ourselves. We would have to compute that ourselves. Okay, sorry, let me make a little bit of a little change to this. So the price earning ratio would basically be so you're gonna so there's an option. Total earnings is an option, is a second possible option for us to use. So it basically be the total value. P ratio will basically be, because we have earning here, so it can be earning over there. So it will basically be the total value of equity or total earnings if value of equity is not available. So if value of equity is not available. So I'm going to read that out because I'm trying to fit that into that very small space. So I just made a change to the formula. So the formula is for P ratio computation is total value of equity. However, if the total value of equity is not available, then we can then use the total earnings or profit after tax. So just take note of that for the P ratio. So that's just an adjustment to that's an adjustment to that formula. That's what it's meant to be. Okay, let us go back to our computation of the value of ZK before. So we're going to go to our question and quickly look at, can we find P ratio for ZK in our question? And if not, can we calculate it ourselves if we don't find it? So we're going to scan it quickly, scan through the question quickly and see if there's anything that has to do with the value of ZK. This had to do with this all had to do with the value of MK, so it doesn't apply to ZK before. This is after the acquisition, so our eyes is not here yet. We're looking at what happens before. So this is after the acquisition. So let's see if we have the P ratio of ZK anywhere. We don't have it in that paragraph. We don't have anything here. We don't have anything here. We might not be given. We're just trying to scan if we have the value of for ZK. We might not be given. So if we're not given, we're going to compute it ourselves.
Six.
Okay. All right. So we don't have anything for that for ZK. So we would do our computation ourselves. Okay. So the value of why did I write the wrong formula here? So this is total number of equity divided by, I flipped the formula when I was writing it. So total number of equity of that divided by the total earnings. Because it's price over earnings, the total earnings. Okay, so we don't have any of that there. So let's now see if we can get our values from our question then. So the value, P ratio is the value of equity divided by total earnings, rather not number of shares, which is a profit after tax. And if we don't have total earnings, if we don't have the total value of equity, we use our total earnings, which will just be 1 in that case. It will be 1 in that case. So let's determine the total value of equity, current value of equity for ZK Limited. So we computed our total value of equity for ZK Limited, total value as 1201 here. Which was our total value of equity for ZK Limited. We computed it as 1201. We now need to divide that by the profit after tax or total earnings for ZK Limited. So the price earning ratio is 1201, which is the value of equity divided by the total earnings or profit after tax. So if you go right to our question where you have the current information, I think we're given there the profit after tax for ZK. So we have ZK Limited here. So you have the profit after tax of 117.1. $117.1 million. Okay, so guys, what is our P ratio? $1,201 divided by 117.1. So what do we have? 10 point what? 10.26. 10.26. So our value. Oh, sorry. Please help us meet if you're not speaking with us. Please help us meet. Help us meet if you're not speaking with us. Okay. So our value formula doesn't change. Our value would then be the P ratio multiplied by the profit after tax, or the total earnings. So that would just be our PE ratio multiplied by profit after tax or total earnings, depending on what you're given in the question. So that would be P ratio. We just computed that as 10.26 multiplied by the profit after tax of 117.1. So what do we have? It's going to take us back to what we have as the value of 10.26 multiplied by 117.1 gives us
1201.4.
so 1201.1, because the one after that 0.4 rather. So the one after that is a 4. So 1201.4. And that gives us the value of ZK before. So let's recap that quickly, because I had to quickly update the formula. All right. So we're saying is that the P ratio approach, you need to determine what the P ratio is, and then you determine what the value is. And the formula for calculating the P ratio is total value of equity or total earnings if value of equity is not provided. So divided by the total earnings of profit after tax. So what that means is that if you don't have the value of equity and we have to use total earnings as equivalent to the value of equity, it will just be the same value. This divided by this will be the same value, which will be 1. But if it's different, we're going to have a different value. So once we determine that, you can then compute the value by multiplying that by the total earnings of profit after tax. That's what we've just done for MK and for ZK. So what that means is that the value before for the two companies would be what value? Would be how much? For MK, it is 2402.6. For ZK, it is 1201.4. So what's the total values before the acquisition? 2402.6 plus 1201.4.
3604.
3604.
Okay, so that is 3604. 3604. So we now need to know the value after, so that we know what the addition is. So the question is, what is the addition? What is the additional equity? So we need to know what the value is after. So let's determine the value after. So if combined, what would be the P ratio? And then what would be the total earnings, so that we can multiply it and determine the value if combined. So let's look at what the question says about what happens if combined. What would be the P ratio? It says right here, we're still around this paragraph now that has to do with if combined. So it stays right here, right in this paragraph. After the acquisition, it is expected that the PE ratio of the combined company will be midpoint between the two individual companies' P ratio. So midpoint meaning half or at the average of the two individual P ratios. So what will be the P ratio of the two combined midpoint of the combined company will be midpoint of the P ratio of both. So we're given what it is. So the P ratio if combined or after the combination will be midpoint, which is half of the P ratio of ZK and the P ratio of ZK. So what would that be? That would be half. What is the P ratio of MK ZK? So what's the P ratio of MK that we computed? 14.05. What is the P ratio of ZK? 10.26. Okay, so what is the midpoint, which is the P ratio of the two companies right now? So what is the midpoint? Or the average of both? So that would be 14.05 plus 10.26 divided by 2. So that gives us 12.06.
Six. 12.16 rather.
Is it 16? So let me do that again with my calculator. 14.05 plus 10.26 divided by 2. Okay, 12.16. Very true. So 12.16. So now that we know the P ratio, the next thing is to determine the value. What is the value? How do we determine the value? The formula is clearly given to us. The P ratio divided by the total earnings or the profit after tax. So the P ratio, which we already have on top, multiplied by the profit after tax. So that would be 12.16 multiplied by the profit after tax if or when combined. So let's go back to our question quickly and quickly establish what is the profit after tax if combined. All right, so right here. So currently, the current statement, the profit after tax is 171 for MK and 117 for ZK. Now, what happens if combined? It says the annual after-tax profits will increase by 62 million due to the combination of the two. So currently it is 171, 117. If combined, it will increase by 62. So what will be the total new value now? It would be 171 plus 117.1 and then plus 62 because it will increase by 62. Our total plus profit, if when we combine, it will increase by 62. So what's the total for us? So currently
350. 350.1.
Okay, so yes. So let me write that out for those that will just be looking at the notes and maybe won't rewatch the video. So currently it is 171 for MK, 117.1 for ZK, and if combined, that value will increase by 62. Okay, so what do you say you have? 350 point what?
350.1.
350.1.
Okay, so what is now the total value after?
And
12.61, not 61, I don't know why. 12.16 multiplied by 350.1.
4257.2.
Okay, so that is
4257.2.
4257.2. Okay, so what is now the addition? It is the value after minus the value before. So that is 4257.2 minus the value before. What is our total value before? 3604. 3604. So what is the additional value that is of equity that is created from this combination?
Six five three
653.2.
Okay, so 4257. Sorry. 4257.2 minus 3604, 653. 653.2. Guys, any question on the additional value of equity created?
Sir, please, I have a question.
Please go ahead.
It's not around this side though. Can you scroll up? Is that place
Okay.
where we're calculating the PE ratio and then you put 90? Yes, the MK, the value before. So why are we
Okay.
using 90?
Why are we using what?
Why are we using 90%? Were we assuming that it is 100%?
Yes, so when someone tells you that your sales is reducing by 10%, it basically means that it's a fall from what it currently is.
So
You get what I mean?
I thought we were going to remove the 10% less from the current value.
It's going to give you the same thing. If that's how you calculate it, it's going to give you the same thing. So let's do that. If that's what you want to do, let's do that. So that would basically be 15.61. It is fall by 10%. So what's 10% of 15.61? It's just a different way of computing the same thing mathematically. So 10% is 1.56.
Okay, wait. Sorry.
So what do you have?
I have, I don't know, I'm having
So
1.56.
Yeah, so you're lessing and it's 10% down. So you're lessing that. So what do you have of the final value? The 15.61 minus the 10%, which is 1.56. What do you have?
14.05.
What?
14.05. 0.49.
Yeah, instead of 0.5. You would always not get an exact value because of rounding up. So what do we have in our own value? What do we have? 14.05. So it's just mathematics, really. So there are different ways people calculate percentage fall or percentage increase. Some people decide to say, let me calculate the 10% and then I subtract it from the original value. It's correct. But the easier way is just to say, assume that the total value, the value is 100%. So it's falling by 10%, taking you to 90%. Is that clear? So just a different mathematical approach to computing that. So that's clear.
Yes.
All right. Okay, so let me see if there are any other questions. Let's see what the chats. Aaron, you said you can see my screen. You should. Can someone else confirm if you can see my screen? Because I want to know if it's general or it's just at my end.
I can see your screen, sir.
Okay. Thanks. All right. So you mean okay? All right. So Aaron, I need to quick log out and log back in. Okay. So there are no other hands. So that's basically our value, the additional equity. So clearly, don't forget that because you're doing rounding up. So if somebody decides to use maybe 3 decimal places or 1 decimal place or maybe just 11, you're going to have a slightly different value due to the impact of rounding up. Just to point that out. Okay. So that's our value of equity, the additional value. Now let's move on to the next part of our question and see what the question is, and then we'll then determine how to approach it, depending on what the requirement is. So we've done our B1. So let's look at what our B2 is. Our B2 says the percentage gain to each of MK Limited and ZK Limited shareholders group under each payment method. So ZK is proposing to make payment or to acquire, sorry, not ZK, MK is proposing to make payment or to acquire ZK using either cash or issuing of shares. So the question is asking us that under cash, what is the gain? What gain would ZK shareholders make under cash payment, and under share payment, what would they make? That's what the question is asking us. And Pride, your hand is up. Can you quickly just go ahead before we can proceed?
Okay, sir. My question is on the PE ratio we computed. So, if when we are giving EPS and market price per share, can we also use EPS sort of like MPS to compute the PE ratio?
Yes, you can. Yes, you can. You can use the price over the EPS to calculate MPE ratio. That's another formula for it as well. So there are different, actually there are different formulas for calculating PE ratio. So we can add that to our formula bank because there are actually different formulas for calculating the PE ratio. So what I've just done is one of the formulas. So the second, another formula you can use, which Mr. Brad just mentioned now. So let me just write that. So this is one formula. Another formula you can use, which Mr. Brad just mentioned now, because like I mentioned, there are different formulas for calculating the price earning ratio. But the valuation, that is the formula, that doesn't change. It's just the PE ratio formula that changes because there are different theory and different approaches to that. So that other formula is, like I just mentioned now, is the share price divided by the earnings per share. So this is another formula for computing the PE ratio. So if you don't have the total earnings or the total value of equity, and you have the share price and you have the earning per share, you can also use that to compute your PE ratio. That's another formula. Because I'm solving this particular question, I don't want to be all over the place. Okay. All right. So just add that to your formula bank, please, for a computation of PE ratio. So either 1 or 2. All right. So let's go right back to the B2 of the question. So we're saying, what is the percentage gain based on the different payment structure? So let's look at the first option. The first option, the MK is saying, is cash offer. We want to pay cash. So if they pay cash, what is the gain to the shareholders? So let's begin with the cash, and then we can then come and look at the shares. So we'll begin with cash. So the current value of ZK before the merger, because that is the minimum value that the owners will accept. The minimum value the owners will accept is the current value. And we explained that when we look at the valuation, when we did the valuation here. So we did that with the valuation here. Now this is the minimum price it can be accepted by the seller. So the minimum price that the seller will accept is 0.60, which is the value. So the current price before the demerger, the minimum price that the seller will accept is 0.60, which is the current price. 0.60. So how much is MK offering to pay in cash? How much is MK offering? And the reason that 0.60 is important to us is because the current owners, which are the shareholders, even without the merger, if they want to sell, they'll just go to the stock market and sell it at 0.60. That's what they would get, because that's the current value before the demerger. That's the minimum they can accept. But how much is ZK offering to sell, so that we know what the gain is to ZK, and then we then compute the gain to MK. So how much is MK offering to buy or pay? In cash, we're looking at cash right now. How much is MK offering to pay? We're going to go to the part of the question that talks about the offer. You're not going to be everywhere. You're going to focus on the part that talks about the offer. So how much is MK offering to pay? MK has proposed to pay for acquiring ZK Limited either through a cash offer of 0.66 for a ZK Limited share. So MK is offering to pay 0.66. So as things stand, without the merger, it's worth 0.60, which is the minimum the sellers can sell. MK has said we would give you 0.66. So to MK shareholder, to ZK shareholders, as things stand, what is the gain if they accept the cash offer based on the current value of the before the demerger? What's the gain? So it is the new value minus the old value divided by the old value. We then multiply that by 100 to give us the percentage. So the new value they're offering is 0.66. The old value, which is the current value, is 0.60 divided by 0.60 multiplied by 100. So what is the gain to ZK based on current terms? Approximately what? 10%. 10%. Okay. So that is the value to ZK based on the cash offer, or the gain to ZK. Now let's look at the gain to MK based on the cash offer. MK is the company that wants to buy ZK. So what benefit is it to MK? So this is MK Limited. MK Limited. For you to know the gain, you must always compare before versus after, or after versus before, depending on how you decide to arrange it. For ZK, we compare the value before the demerger of 0.60. We compare it with the after value that you get when you sell of 0.66. So before the demerger, the current value is 0.60. After, for the offer, is offering 0.66. So we're comparing the two to determine what the gain is. So for MK as well, we're trying to determine what is the value of MK before, which would be the original value. So we can do that quickly because we've computed the value before when we're doing MK, the additional equity value. So before the any form of acquisition, MK value is 2402.6. Before any form of acquisition, MK value is 2402.6. So that's the value before 2402.6. Let's determine what that translates to per share. Because the question says what is the gain to each of the shareholders? So all the time translate what that translates to per share by just dividing that by the number of shares. So how many shares do we have in MK? Just dividing that by the number of shares. How many shares do we have in MK Limited? Okay, how many shares do we have in MK Limited? So right here, it tells us what we have in MK Limited. It says MK Limited's debt to equity ratio is estimated at 40/60 in equivalent market terms, and it has 1,200 million shares or 1,200 million shares in issue. So the value before is 2409 to share with 1,200 shareholders. So how much does that translate to per share before? So that's not 240, but 2402.6. Two four zero two 2402.6. So divided by the number of shareholders, which is 1, 2, gives us what is the value per share for each of the shareholders before any form of action is taken.
2.
So that is
2.0.
Yeah, so that is 2. So before any form of merger has taken place, the value of equity is 2402.6. There are 1,200 million shareholders, so that is 2. Now, but after the demerger, what is the value so that we know if it makes sense or not to MK shareholders? So after the demerger, the value of the combined company after the demerger is 4257. This is the value of the combined company after the demerger. It is 4257.2. However, the additional value is not coming for free. MK will pay for it. So how much are they paying so that we know what is left for the existing shareholders? So after the demerger, it is 4257.2. 4257.2. The increase from 2402.6 to 4257.2 is not free. MK has to pay for it. So how much did they say they will pay for it so that we know what is left? How much did they say they will pay? How much did they say they will pay? They said they will pay 0.66 per share. That's what they said they will pay. They said they will pay 0.66 per share. So how many shares were in ZK Limited? There were 2,000 shares in ZK Limited. So that is 0.66, and there were 2,000 shares in ZK Limited per share. We already discussed 2,000 shares before now. So how much is now left for them? So that will be 0.66 multiplied by 2,000. What do you have? So this is 1,320. So that is 457.2 minus 1,320 gives us 2,937.2 as the net value. So per share, that would be, so per share, that would be 2,937.2. I need to rewrite that value so that it's legible. So per share, there are 1,200 shares. We're not issuing any share. We're just giving them the cash and moving on. So that would be 2,937.2 divided by 1, 2. What is our current value after we have gotten ZK and we've paid for it in cash? So what is our new value to our shareholders? 2,937.2 divided by 1, 2. 2 point what?
I'm getting
4, 5.
2.4. 2.4.
Yeah, 2.45. So that's our net. So what is the gain to MK? And then we'll now do a quick recap and take questions. So before the merger, it was 2 naira before the merger, and that was pretty straightforward. The value we calculated divided by 1, 2. After the merger, The value after the merger is 4257.2, but that additional value did not come for free. We have to pay cash from our pocket, and the cash we are paying from our pocket is 0.66 per share, and the ZK is coming with 2,000 shares or has 2,000 shareholders. So how much are we paying in total? 1,320. So total minus what we are coughing out of our pocket to pay for it gives us a remaining one for our value for our shareholders of 2,937.2. So the gain becomes the new value, which is 2.45 minus the old value, which is 2, divided by the old value, which is 2 multiplied by 100. So what does that give us? 0.45 divided by 2 multiplied by 100. So that gives us approximately 22.5.
0.4.
22 point, is it 0.4, 0.5 or 0.5? So let me confirm that. 2.45
22.5%.
22
divided by 2, so times 100, so that's 22.5%. Okay, so whenever in valuation you are determining an increase again, you must always compare the old versus the new, or compare a value before versus a value after. That's what helps you determine whether or not you are making a gain from the transaction. Any question on the cash offer, guys? Please, if you have any question, let's chat. That's the reason why we're having this session.
God, this thing is so long.
Yeah, but the good thing is, like I mentioned, the tip is when you're reading the question, focus on the area that is related to that question. The reason why it's taking time is because I'm explaining. If you're solving an exam question, it's pretty fast. Now you're not going to be asking, do you have any question? And you're not going to be pausing like I'm pausing right now. I'm pausing so that it will sink in, into you guys. Okay. So let's now look at the value based on the share. Because the question says we should calculate the gain based on the offer of shares, and we should calculate the gain based on cash. Now we've done the gain based on cash offer. Let's look at the gain or loss based on share, because MK is saying we would offer cash or we would give you guys shares. So let's look at the other part, which is the gain based on share issue. So gain based on share issue. So what is MK offering to issue in terms of the shares? So let's look at what MK is offering to do. All right, so let's look at what MK is saying. MK is saying here, MK Limited has proposed to pay for acquiring ZK Limited either through a cash offer of 0.66 for a ZK Limited share, which we have done that, or one MK Limited share for every one MK Limited share for every 3 ZK Limited shares. One MK Limited shares for every 3 ZK Limited shares. MK Limited will borrow the money needed to pay for the acquisition. So the second proposal is to say for every one of your share, every 3 of your shares, rather, will give you 1 MK Limited share. For every 3 of your share, will give you 1 MK Limited shares. So let's now determine how many shares that will translate to for ZK shareholders. Let's begin with that, and then we can then begin to compute what the gain is first. So how many shares does ZK currently have? Because they're giving us 1 MK for every 3 of our shares. How many shares do we have? We currently have what? Currently have how many? 2,000 shares in ZK. So they're giving us 1 for every 3 that we have. So what would that translate to? And then we can then compute what the gain or the loss is. So let's begin with the number of MK share to be issued. 1 for every 3. Currently, ZK has 2,000 shares. MK to issue. So 1 for every 3. Or how many shares would that be? 1 for every 3. How many shares would that be? How many shares are they issuing to us?
6.67.
Okay, so we can't have a point for number of shares. So we have to round it up.
67.
To 667. Because is that 1 share, 2 share, whatever. So we can't have a decimal point for number of shares. So that is 667 million shares. So this is what they are offering. So now that we have that, guys, let's now calculate what would be the value or the gain to MK and the gain to ZK. So let's begin with ZK like we did before. What is the current value of ZK? Because we always compare before and after. If ZK does not merge and they decide to sell their share, what is the current value? The value before, it doesn't change. What is that? What is that?
1201.
0.60. Which is the minimum that the seller will sell. The minimum that the sellers will sell is 0.60. That is the value before the demerger. So anything you're comparing it against 0.60. Because if ZK Limited shareholder decide to say we are not merging and they go to the market to sell, they will get 0.60. That is the value before the demerger, 0.60. Same thing like we did here, 0.60 against what they offered of 0.66. So the value before the demerger is 0.60 per share. So we are giving up 3 of that. We are giving up 3 of that for 1 of MK. So in monetary terms, what does that translate to? So we're giving up 3 of our share for 1 of ZK. So in monetary terms, for three of ZK shares currently, how much is it worth? For 3 of ZK shares currently, how much is it worth? We're giving up 3 of our shares for 1 of MK. So we need to compare 3, or we divide the value of the other one by 3 to go to per 1. Whatever you decide to do, you're going to arrive at the same answer. So we look at the price per 1 of MK, which is 0.60, and we compare it with per 1 of MK. When we compute it, you're going to get this. Or we say, okay, 3 for ZK against 3, the 1 for MK, because we're giving up 3 of ZK to get 1 of MK. So since we're giving up 3, what is the value of the 3 of those our shares? So that is 0.6 multiplied by 3. What does that give us? 1.8. So we are giving up 3 shares. So we are giving up 3 shares. We are giving up 3 of our shares.
I don't understand.
For 1 of MK. Okay, so let's take that one more time. We're looking at the value before and we're comparing with the value after. The value before is 0.60 per share. Is that very clear? 0.60 per share. Is that clear? Is that 0.60 clear? We've computed that. That's clear. MK is telling us that for every 3 of our shares, they will give us 1 of their own share. That's what they're saying. For every 3 of our shares, they will give us 1 of their own. So what that means is that we are giving up 3 to get 1 of MK. So if our current value is 0.6 per share, For the 3 we are giving up to get 1, we're expecting a value of 1.8. That's what it means. What it basically means is that whatever the value of MK is for us, because we gave up 3 to get 1 of that, it must not be less than 1.8. Because we had to give up 3 to get 1. And that is why we're multiplying the 0.6 by 3 to determine what the value is based on the 3 we're giving up to get 1. Any question? I hope that's clear. If any question, you can make use of the hand raise feature so that I can address that if I'm moving forward. Bossade, your hand is up. Go ahead quickly.
Well done, sir.
Yeah, thank you. Go ahead, please, for the question.
Please, I didn't understand how you got this this old share 0.60.
We've been, so that one,
Or
I might think maybe, okay, so we've done that a long time ago. We're just using the same value over and over again, which is the value before. So if this was where we did the calculation. So I'm just copying what we've done before. This was where we did the calculation. Can you say it?
Okay.
Yeah, and how did we get it? It is the current value of equity for ZK. We've done that a long time ago. So we're using the value over and over again. So all we just did was just to get, where did we calculate the value? We calculated that down. So all we did was just to, so you would need to, yeah, so we're just reducing the value. It's nothing new. We're just reducing the value because that is the current value. So which is basically based on what we did last week, which is the value of equity for ZK from our solution last week. So if you missed that last week, I would advise you will be watching the video last week so you get the answer to how we got the 0.60. Is that okay?
All right, thank you,
All right. Okay, so we're multiplying it by 3 because we're giving up 3 to get 1 of MK. So now we've got 1 point. So what is our value of MK now after the merger so that we know whether we're making a gain or a loss? Okay, so what is the value after the merger based on the share issue? Share value. After the merger. Because they are giving us their shares. They're not giving us cash this time. They're giving us their shares. So we want to know what is the share worth. What is the share? That's the share they are giving us. What is it worth? That's what we're trying to establish. What is it worth? So that we know whether or not we should take it. So what is it worth? Now, after the demerger, after the merger, after we merge, this is the total value. So after we merge, this is the total value. That is after we merge. Now, how many people will share this value? How many people will share this value? That tells us what the new share price would be. So after the merger, our total value, our value is 4257.2. 4257.2, which is the same thing that we have here. 4257.2. We are not paying cash from our pocket. We are not paying cash from our pocket. Instead, this amount will be shared by not 1,200 anymore, because we are issuing new shares to the shareholders of ZK, and we're issuing new shares to the shareholders of ZK of 667 million shares. So this 4257.2 will now be shared by the existing MK shareholders of 12 plus the new ZK shareholders of 667. We're not paying any cash, so nothing is going out of our hands. So that's why we're not subtracting anything. So how much would that translate to? So this will now be shared by the existing 1,200 shareholders of MK plus the new shares we're issuing to ZK shareholders of 667. So that would be 4257.2 divided by 1867. So what is the current value now to us? after the merger. 4257.2 divided by 1867. So what do you have?
2.28.
2.28. Okay, so what is the gain to our shareholders? So the gain is the new value is 2.28. The old value is 1.8 divided by the old value of 1.8 multiplied by 100. So what do you have? What do you have, guys? 26.7%. 26.7%. Any question, guys? So that's one thing you can do. Another option you can do if you didn't want to multiply this by 3, you can just divide this by 3. So you can say, okay, I want to do per share. So I'll just say, okay, this is 0.60. So if you don't want to multiply by 3, you can say, okay, this is 0.60 per share. And you can say this 2.28 is for 3 shares that we gave up. That 2.28 for 3 shares we gave up. So meaning per share would be 2.28 divided by 3. 2.28 divided by 3. So that would be 0.76. So you can then compute your increase based on this, and that will still give you the same 26.7%. So whatever you do is correct. So either you look at it this way or you approach it this way. At the end of the day, we want to compare like for like because we give up 3 shares to get 1. So it's either we make this 3 so that it will be 3 against 3 here, or we divide this by 3 so that it's 1 to 1 here. Whatever you do, you're going to still arrive at your 26.7%, and both options are correct. Any question on the increase to ZK shareholders from the share issue? Please make use of the hand raise feature if you have any questions so we can address that. Any question?
Hello, sir.
Yes, please go ahead. I'm just pausing so that you guys can take it in. Yeah, go ahead, please, if you have any question. Yeah.
Yes. When you are calculating the PE ratio, you use total earning divided by number of ordinary shares.
No, I updated that. No, I updated that because I updated that formula. So because like I said, there are different formulas for PE ratio. So I updated it based on the information we have.
The calculation of PE ratio, the formula that we are familiar with is market price per share over any per share. If we use that one, are we still going to get that?
So hold on. So that is the second method here. Okay, so do you have the earning per share? If you don't have the earning per share, then you cannot use this method. So do you have the earning per share for ZK Limited, and do you have the share price for ZK Limited? So you can't use that second method. So you use the method based on the available information.
Okay.
You get what I mean, right?
Okay, sir.
So the method you use is based on available information in the question. So if you have the information to use this method, please you use this method. But if you don't have the information to use this method, you're going to use this method. So it's all about, look at your question. What do you have in the question? And
but
if you have that information,
the method is the same thing as calculating any per share. When you are calculating any per share, you use profit after tax divided by the number of shares. You get our any per share.
Yes. Yes, that was the method I wanted to write. That was the method I wanted to write in the formula before when I first said profit after tax divided by number of shares. But then I realized that the information in the question is going to be a long method to go into that. So if you want to do that, but you don't have the share price, you don't have the share price for MK. So you even if I calculate the earning per share, okay, so even if I calculate the earning per share, you don't have the share price for ZK, so we can't still use it. Is that clear? You
yes,
get that?
sir.
Okay.
Yes, sir.
So there are three methods. So you need to know the three methods. There are three methods really. So when I first wrote the total earning divided by number of shares, I was looking at one of the methods, but then I realized that in the question they didn't have that information. They didn't have the share price, so I didn't go with that method. So maybe we can summarize. We can just re-summarize it for you guys what the methods are. There are three methods. The first method is you have share price divided by earning per share. The second method is that you're calculating the earning per share yourself, which is the profit after tax divided by the number of shares, which is what I was trying to write before, and then I cleaned it because I didn't have the share price. Okay. So once you then calculate the earning per share, you can then calculate price earning ratio. Okay. So yes, I can summarize that for you guys when we're done with this question, so that we can save on time. Okay. Okay. So let's move a little bit fast. Yeah. All right.
Yes, sir.
All right. So that's what do you call it? That's the value to the gain to ZK shareholders. So let's quickly do the gain to MK shareholders, please, quickly. To the gain on shares. Whenever you're determining the gain, the profit, you must always compare before and after. So before, what is the value for MK shareholder? Before the merger, what was the value for MK shareholder? We've done that before. We just copied and paste. So for MK shareholder, what was the value before? Can you see it here? What was the value before?
2402.6.
So the value before for MK shareholder is 2 naira. We calculated that before.
Sure.
Yeah, just go a little bit up. The value before for MK shareholders is 2 naira. We have computed that before.
Okay, yes, 2 naira per share.
Yes, 2 naira per share. So that was the value before. Now, after the merge, and they now share the profit by a total of 1867. What is the value after of our shares?
2.45.
2.28. So that is 2.28. So what is the gain or loss? So it is 2.28 minus 2 divided by 2 multiplied by 100. So what do we have?
14%.
14%. So what is the key takeaway? Whenever you are computing the value, gain or profit, you must always compare the value before and after, because that's the only way you can know whether you're making a gain or not. You want to know what is my value before we undertake this transaction, and what is the value after we will undertake this transaction, and that will tell you whether or not you have a profit or a gain from the deal. So take a moment to sink it in and let me know if you have any question from our computation of the gain on the two methods. Any question, guys? Any question? Okay. So let's look at the next question, which is the D3. And then we can then quickly go back to the formulas on PE ratio, because PE ratio has a lot of different formulas that you need to know. I only focus on what I needed for this question, but we can go back and do a quick recap so that you don't get it mixed up in exam context. This 3 question says, what is the impact, estimate the impact of MK's capital structure under each payment method. What is the impact on the capital structure under each payment method? So when we say capital structure, we're basically saying what is the percentage equity and what is the percentage of debt in the total financing under each capital structure. That's what we're basically saying. So that is our C. So our capital structure under each payment method. So we're basically saying what is the percentage of equity is to debt, or debt is to equity, regardless of how you decide to arrange it. So what is the percentage of equity is to debt? Please make use of the hand raised feature if you need to speak. Please make use of the hand raised feature if you need to speak so that I can address that. Okay. Okay. So you can go ahead quickly. Please go ahead with the question quickly, please. We need to round up with this.
That 2.28 was ZK, sir.
Is what?
Is it for ZK? The 2.28 is for ZK.
No, that is the total value of the shares after the merger, because by the time you merge, everybody is going to be under the same company, right? So that's why we're sharing.
Is it for ZK?
For both of them.
Sorry, sir.
The value of the share. Hold on. Let me answer your question. Hold on, let me answer your question. So the value, the 4257.2 will be shared by everybody after the merger, because after the merger you have 12 MK plus 667 of the new shares that are issuing to ZK. So the total number of shareholders you would have is now the new company now. So the total number of shareholders will be 1867. So that gives us a total of 2.28 for everybody, because this was shared by both the old and the new. So the 2.28 is for everybody, because when you merge a company and you issue shares, everybody now becomes one, right? You don't say, oh, the old shareholders, these are your own share price, the new share. No, everybody is now under one company. So the same share price applies to everybody. It's just that the profit before that was shared by 1,200 people will now be shared by more people. The value that was shared by 1,002 will now be shared by more people, meaning that the total value will be updated to reflect that. So this 2.28 is the value that is not applicable to both the new and the old. Is that clear?
Yes, sir.
Yeah. So whether you are a ZK shareholder that have now been given an MK shares, your share price will be 2.28, because that's the new MK share price. And if you're an existing MK shareholder, your price is 2.28, because that is the new share price after the merger for the company. Is that clear?
Yes, sir.
All right. So let's get back to our question quickly, guys. I want to just round up this. Okay. So when we say capital structure, basically saying what is the percentage of debt and what is the percentage of equity in the company. So the question is telling us that, can we determine what will be the capital structure under cash for cash, so that under the cash payment, and what will be the capital structure under the debt payment. Now, before we can do any of that, we need to determine what the current status is. What is the current capital structure? Before we can do any of that, we need to know the value before. What is the current capital structure? So we're looking at for MK. The question is for MK. So when the question is for MK. So we need to determine what is the current capital structure. Current capital structure. So what is the current capital structure for MK? So we need to determine what is the value of equity, what is the value of debt. We don't know what the percentage or what the percentage are, if we have any, or if we have that in the question. So let's go right back to our question and see the value of equity for MK currently before any merger. What is the value? MK Limited, the value before is 2402.6. This is per share. We're looking at the total value. This is per share. So the value before is 2402.6. So that is the value of equity for MK before any form of merger is 2402.6. So that is our value of equity. With value of debt, we need to check if we have that in the question. And then that would give us whatever the capital structure is as it is currently. So let's quickly go back to our question and see if we have anything on the value of debt. We can then determine what percentage are. And if we don't have anything on the value of debt, maybe we're even giving the percentage. We can then use that to determine what the value of the debt is before anything happens. So let's do that quickly. So before, so this part is after. We're looking at before. So we're going to look for where we have information before. So this is information that applies to the acquisition. So that is after. We're only interested in value before. Okay, so this has to do with the value before, because our concern is on MK. So it says MK Limited debt to equity ratio is estimated to be 40 to 60 in equivalent market value terms. And so currently it is 40 to 60. In other words, debt is 40%, equity is 60. So where we right back. So in other words, we're saying that our debt is 40% of total financing. Our equity is what? 60% of total finance. Because the current capital structure is 40-60, debt is 40% and equity is 60% of the total. So from this, we can calculate the value of debt quickly. So we don't know what the total is, but we know that the total of 60% of the total for equity gives us 2402.6. So we can say, let's even say let the total be X. We don't know what the total is, but we know that for equity, that 60%, which is 0.6 of whatever the total is what gives us 2402.6. So what is the total?
2404 divided by
0.6. So what do we have? So 2406.2 divided by 0.6 gives us 4010.3 as our total. 4010.3 as our total. So what is the value of debt then? Current value of debt. 4010.3 minus 2402.6, or you just say 40% of, or you just say 40% of 4010.3. So whatever you do, it's going to give you the same answer. So what do we have?
That should be 4004.3.
Let's do that again. 2402 divided 0.6 divided by 0.6. So what? Sorry, what do you have?
4004.3.
Okay. So where did I get 4010? I think I need to change. I need to change my calculator. I think it's beginning to give me wrong values when I press on it. So 4003.3 0.3004.3. Please, you guys should be double checking with me. I think my calculator is messing me up, so you guys should double check with me, please. Okay, so that is just quickly update this. 4004.3. So that is 4004.3. So you can either say 4004.3 minus that, or you say 40% of 4003.4.3. Whichever you do, you're arriving at this. It's the same approach, just different ways of computing the same thing. Just different ways of computing the same thing. So whatever you do, you'll just arrive at the same value. Okay, so what do we have as the value of debt? $4,004.3 minus 2402.6 gives us 1601.7, or you just say 40% of that value, since debt is 40%. Whichever one you do is basically the same thing. Okay, so let's now look at the value based on the two payment method now. So let's begin with cash. If MK were to pay cash, what is the value of equity? So we have to go to our solution where we have to go to our solution where we have the value of equity when cash is paid, so that we know what if MK were to pay cash, what would be the value. So we're going to our solution where we did the value based on cash. So this is the cash offer. So if MK were to pay cash after they've completed transaction, the value for MK would be 2937.2. This is divided by 1 2 because we're interested in per share, but now we're looking at a total. So 2937.2 is the value of the company, or the value of equity if we pay cash. So that is 2937.2. Quickly, so we can do that. 2937. So let me copy that again. I missed 2937.2. 2937.2. 2937.2. So that is the value right now. What is the value of debt? Currently, before the merger, our value of debt is 1601.7. 1601.7. When we pay cash, how do we get the money? Is it from our pocket, or we're going to borrow? If we're going to borrow, it will increase our debt. If it is from our pocket, it doesn't increase our debt. So let's look at, if we're paying cash, how do we get the money that we use to pay cash? If we borrow, or it's from our pocket. If we borrowed, it will increase our total debt by whatever amount we borrowed to buy the company for cash. So what did we do? What did we do, guys? So right here, it says, this paragraph here, it says MK Ltd will what? They will do what? Borrow the money needed to pay for the acquisition. So it will increase our debt. We are borrowing now. So how much are we borrowing that we used to pay for our debt? How much is the cash value we are paying? We are borrowing that amount. How much is the cash value that we paid? Let's go to that cash offer to see what we paid in cash, if one of the cash terms. How much did we pay in total? We paid we paid 0.66 per share for 2,000 shares. We paid 1,320. So we borrowed it. If we didn't borrow it, it would not be loan for us. So we paid 1,320. Now, one more thing before you move on, you need to ask yourself, we are acquiring ZK. Did ZK come with any debt that we have to we will include in our book? Did they come with any debt when they are moving them to us? Did they come with any debt? Yes, they did. Yes, they did. We did that last week. The value of debt for ZK that is moving when they move. So we did that quickly. So let's quickly look at it in the question. So right here, it says in this paragraph, we reviewed it last week, but let's quickly read it one more time together. It says, Kola PLC's loan note A currently have a total value of this. Loan note B have a value of 400. It now says that after the unbundling, loan note B will be serviced by ZK. And loan note B is 400 million. So if loan note B is serviced by ZK, and ZK is now acquired by MK, clearly MK is going to take on that loan because it comes as part of the company. So you have that 400 million that is coming from ZK as well. So you have that 400 million that is coming from ZK as well. So you must not forget that. Always check if it's coming with any loan from the parent company. So plus the 400 that is coming with ZK. Okay, so what is our total so that we know what the new capital structure is? 2937.2 plus what is our loan? We started with 1601. We started with 1601.7. We borrowed 1320 to pay cash, and the company came with a loan of 400. So what's the total? 3321.7. So plus 2937.2 gives us 6258.9. So what is the percentage? So the percentage would be 2937.2 divided by the total 6258.9 times 100. 3321.7 divided by the total 6258.9 multiplied by 100. So what's our percentage? What's our new capital structure percentage now? So the first one, 2937.2 divided by 6258.9 multiplied by 100. So that is 49. Sorry, not 49, 46.
The first one is 47%.
Okay. So we can call it 47% if we don't want to put decimal place. So the second one, I don't need to compute it. It will be the balance to take it to 100%, which is 53%. So you can quickly confirm that. Okay, so let me see that if there are any question, I can quickly take that, and then we can then do the second one quickly, which is the last part of our question. Iberi, your hand is up. Please go ahead.
Please, this 1320.
Yeah.
How is it debt?
Okay, so we borrowed. MK is going to borrow the money, the cash they want to pay to the shareholders of ZK. They're going to borrow the money. So if you borrow the money, what is that to you?
It was it in the question. Did they say it was the borrowed money?
Oh, yes, they did. I read that now when we were doing it. So let's read that quickly one more. We read that. Maybe you missed when I read it. I read it when we were solving it. We read it when we solved. Look at it right here. So let's read it one more time quickly. Maybe you missed that when we read it. Can you see here? MK Ltd will borrow the money needed to pay for the acquisition.
Okay.
Did you see that?
Yes, thank you.
You seen it, right?
Yes, I have. Thank you.
All right. Okay. So let's look at quickly our final part, which is the share for share, and then we can then round up our business valuation. So let's look at the capital structure for share quickly. Can do that within the next 5 minutes. I know we'll pass our time, that we've, just in case you have other commitments. So let's do that quickly. Capital structure post acquisition, share for share. So what is the value of equity for MK based on the share for share offer? Not based on the cash, but based on the share for share offer. So we're going to our computation of the share for share offer and looking at the value for MK. So where is the share for share? So this is cash. So this is based on share issue. So what is the value for MK? So the value for MK is total value before you divide by number of shareholders. The value for MK is 4257.2. We divided it by the number of shares because we wanted to know per share, but the total value before you divide it by the total people is 4257.2. So that is the value for MK. And the reason is because we are not paying anything out, so there's no need to subtract the cash that's leaving our hand. Nothing is leaving our hands. So the value is 4257.2. 4257.2. The value of debt. Before the merger, we had 1601.7. We are not paying any cash. We are issuing shares. We are not borrowing anything. So that 1320 is not applicable for our share for share issue because we are not borrowing anything, but because we are not paying any cash. We're only issuing share to them. So that remains. That will not be applicable. However, the loan that ZK came with will be there. Okay, so what is our total? 4257.2. So what's the total for the debt now? What is the total for our new debt? $1601.7 plus 400. 2001.7. So what do we have as a total so that we can determine what the new capital? 4257.2. 6258.9. Okay, so all the time what our percent the capital structure is. So the first one would be 4257.2 divided by the total, which is 6258.9 multiplied by 100. What do we have?
68%.
4257.2 divided by 6258.9. Okay, 68%. So the other one will just be the balance. I don't need to compute that. You can compute it yourself. So difference to take us to 100%. This would be 32. So that would just be 2001.7 divided by the total of 6258.9 multiplied by 100. Any question on the capital structure? Okay, so let me see. I think I have some messages in the chat. Let me quickly catch up on that. Okay, Gift, you say you didn't get the B11. I hope you get that now. But if you don't, can you just let me know what part of the B11 you didn't get? Also, the B11 we did, B12 we did the share and as well as the cash offer. Okay, So quickly now, before we round up, I said I was going to spend a few minutes on the PE ratio method, and that's because there are different formulas for the PE ratio. So you need to understand that the most important thing with PE ratio is the value formula, which is your profit after tax or your total earnings multiplied by the price earning ratio. Now, the price earning ratio itself has different formulas, two broad formulas. The first formula is that your price earning ratio is equals to your total market value or total value of equity divided by your profit after tax or total earnings. So this is your formula one. So if you have your total market value of equity, you have your profit after tax, you use formula one. The second formula of your price earning ratio is your share price per share divided by the earnings per share. That's the second formula. So you are going to use either formula one or formula two. So I always tell people, if you want to use formula two, always ensure that you can see the share price in the question. If you cannot see the share price given to you in the question, you cannot use formula two. So even if you calculate your earning per share, you cannot see the share price, you cannot use formula two. So always check first that you have the share price. If you don't have the share price, then you know that formula one is the one that you would use and that is applicable. Now, if you do formula two, it might get a little bit extended because sometimes you might be required to calculate the earning per share. And that was the formula I was writing initially when I now look at the question again and I remember that there was no share price in that question. So that formula two will not be applicable. So if you're using the formula two and you have the share price and you're trying to calculate the earning you're trying to calculate the earning per share part, the earning per share would just be your profit after tax, which was the formula I was writing before, divided by the number of shares. So let me just summarize. Formula two would only be applicable where you have the share price. Formula two can only be used where the share price is given or can be computed. Or can be computed. Okay, so that's basically the formulas for your PE ratio. But at the end of the day, the value would be whatever your PE ratio is multiplied by the profit after tax or total earnings. Any question, guys? Okay, so that's been our consideration of business valuation. So this is what I'm going to advise. If you remember, we did say at the start of our question that there are different valuation methods. And what you do depends on the information you are given in that part that you're interested in. So if you have a question on business valuation, one of the key things to be asking yourself is just zero in on the specific part of the question that has what you're trying to compute. Are you trying to compute value before or if merged? Focus on that part and do your computation. But you need to determine for yourself which method to use. And we explained at the start of our class that there are different methods And these are the methods that we explained right here. So if you have information on price earning ratio, you use that. If you have information on any yield method, you use that. If you have information on cash flow method, asset-based method, you use all of that. I have a video on the past question that only tests students' ability to determine value based on the different methods. So if you're interested in practicing how to compute value using asset-based approach, dividend valuation method, I would advise that you watch that video. I can share the link to that video to the WhatsApp group, and you have a look, and then you catch up on that. Outside of that, all of the principles we have discussed is going to be applicable. What would basically change would just be the method you use based on the available information. And always bear in mind a very important concept. If you're trying to determine a gain or a loss, always pay attention. You must determine the value before the merger, the demerger, whatever you want to do, and the value after. That is what will tell you whether or not it is a good deal. Always bear that in mind. And always bear in mind as a very important second tip is this computation here. The computation of the value before and after for the new company. So let's go down to that part. Yeah, that's what we have right here. Yeah, this part of the question. Yeah. So if demerged, this is the value for ZK, which is a new company on its own. And without the demerger, we computed the value as 0.60. Always ensure that you know those values, because if you are the one that is selling, you cannot sell below the 0.60, because that is the current value of your company without you doing anything. Without you doing anything, that is the current value of the company. So if you decide to say, I want to sell my share price now, you just go and collect 0.60. So why would you sell the company for less than 0.60? It doesn't make any sense. So always know that value. And then the value after the merger is what happens after the transaction, 0.75. So if you are the one buying, you must not pay above this, because whatever you are buying is worth 0.75 per share. That is what it is worth. So why are you going to pay 0.80, or why are you going to pay 0.90? So you know that as a buyer, you shouldn't go above this. And as a seller, you shouldn't sell below this, because that is your current value. And as a buyer, this is the current value that the new company is bringing in to you as an acquirer, if you're acquiring or whatever you're doing. Any question on mergers and acquisitions, so we can round up that? Okay. So let me check my chat finally before I close out. Okay. Thank you, Gift. You can send me a private chat if after watching the video you have any question. Okay, so guys, thank you so much for your time. And please do have enjoyed your. Okay, somebody say something.
The P ratio you gave us the formula. Hello, sir. The P ratio you gave us the formula. The other any yield and all those other investors ratio,
those are other valuation methods. Okay. Those are other valuation methods, and I explained it that there are other valuation methods. So if you want to watch, if you want to see a question that asks you to compute a value using all the different valuation methods, I have a video on the YouTube channel for that, so you can watch that video. Okay.
Okay.
I can share the link.
And then what to send the link of that one, please, for us.
Yeah, I can share the link. So you can see this is the earning yield method. So this is another, it's a completely different method from the PE ratio method. Okay, it's a completely different method from the PE ratio valuation method. So it's another completely different valuation method. All right, guys, thank you. Have a good day. So I'll share that, and then I'll share this video as well. So I encourage you to watch the video and resolve the question yourself. Once you do that one more time, you should be perfectly fine. All right. Thank you so much, guys. Have a good day, everyone. Thank you.
Thank you very much, and God bless.
Thank you. Thank you.
Thank you very much.
Thank you, sir. Thank you, sir. Thank you for your time.
Welcome.
Thank you.
Thank you, sir. Thank you, sir. Thank you for your time.
Thank you.